Hello and welcome to this session in which we will look at the CPA exam simulation that deals with internal control for the sales and collection cycle. We have 10 different controls, and what we're going to do, we're going to identify whether we have a strength or a deficiency in the internal control based on this independent activity. And for each item, whether it's a strength, if it's a strength, we're going to specify the transaction-related audit objective addressed by the control. Remember, it's a transaction-related audit objective because we're looking at internal control and we're testing the transaction to determine whether this control is good or not. If it does, if it's a strength, if it's a deficiency in the internal control, what we're going to have to do is explain the nature of the control deficiency, why it's a deficiency, what's wrong with this transaction. So we're going to go over each transaction separately. For example, the first one, credit approval is handled by an independent credit department. Determine whether this is a strength in the internal control or a deficiency. If it's a strength, specify the transaction-related objective. So what audit assertion, audit objective does it meet? If it's a weakness, explain why it's a weakness. On the CPA exam, what you will see is, for example, this is the control, credit approval is handled by independent credit department. And you will have a drop-down box. You would say whether it's a strength or a deficiency, what objective is it meeting, and select a statement about analysis. And this is what we will do in this session, going over each single transaction, step by step. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Starting with the first one, credit approval is handled by an independent credit department. Is this a strength or a deficiency? I would say definitely this is a strength. Why? Because you want the credit approval to do what? To be done by someone independent from handling the sales. Why? Because people that's handling the sales, they have every incentive to approve the credit. They want to get their commission. They want to increase their sales. They want to look good. They don't care about what's going to happen down the road. Now, which objective are we dealing with here? It's occurrence. It's occurrence in a sense that it happens, we have a legitimate credit sales because it's approved by an independent party. So we have a client. So that the objective is occurrence. What's the strength? Ensuring sales are legitimate. The sales actually occurring and to a real customer. Without independent credit approval, anyone can make a sale to a fictitious customer, because you could approve someone, whoever you want to, someone on paper that doesn't exist. But when you have this job outsourced to a independent party, and you could even outsource this to a third party, someone outside your company, you would say no sales can be made until this credit checking company approves the credit of that customer, like a financial institution. So you would only have sales under those circumstances for legitimate customers. Let's take a look at the second one. Recording shipments in the sales journal. So after a shipment is made and recorded in the sales journal, all shipment documents are marked recorded by the accounting team. Is that a strength? Yes, it's recorded. Excellent. We want to do that. Now, what's the objective? We are accounting for all the sales. It is completeness. So we have a shipment. Once the shipment made is done, recorded, once it's made, it's recorded as in the accounting by the accounting team. Great. We're capturing all the sales. Completeness. Ensure all shipment are recorded as sales, avoiding missed revenue. Missing records lead to incomplete financial statements. So that's another strength. Let's take a look at 3. Sales returns are provided to a sales department clerk who prepare a written and pre-number receiving report. Is this a good practice? So sales returns are provided to a sales department clerk. Prepare a written and pre-numbered receiving report. Great, we have a pre-numbered and receiving report. But should the sales return be provided to the sales department? Who made that sale? The sales department. Should they accept the return? Absolutely not. This is a weakness, deficiency. This is a deficiency. There's no objective here. There's no deficiency. Sales clerk handling returns create risk of fraud. Remember when we talked about sales returns and allowances? We had a whole session about this. They can pocket the cash and forge documentation. Proper receiving procedures should be implemented. The return should be handled separately, not by the sales department. Cash receipts handled by the secretary. Is this a good practice? Yes. Why not? The secretary does not have any accounting capability. If she's receiving the cash, great, because she cannot change the record, or he or she cannot change the record. It's a strength. So what is the objective here? Completeness. All the cash, the secretary will have no incentive to steal it because the secretary cannot change the record. So separation of duties, prevent manipulation, ensuring all cash receipts are accounted for. We met the completeness. 5. Cash receipts received via mail are sent unopened along with the remittance advice to the accounting department. Is this how we handle cash receipts? Is this the proper way? Absolutely not. When we receive cash, someone other than the accounting department should have access to the mail, open the mail, and separate the check from the remittance advice. Or if we don't have a remittance advice, create one or make a list. Separate the checks or make a list. And this part here, the remittance advice or the list of whoever paid, only goes to the accounting department. Therefore, there's a deficiency. Why? Because segregation of duties. You don't want to have the accounting department have access to the checks and the record. Blurs responsibilities of cash handling and record keeping. Checks should go to the cashier first. They could go to the secretary for that matter. It doesn't not matter. And the remittance advice should be handled by the accountant. So the secretary would open the mail, separate the checks from the remittance advice. And if you remember when I talked about internal control about sales, I told you, actually I did this step when I work at City Financial, where, either I or someone else or 2 individuals would open the mail and separate the checks from the remittance advice. We would give the remittance advice to the manager, and one of us will deposit the check and bring back the receipt. So those 2 should be independent. Now, what do you want to do? You want to go to Farhat Lectures, look at additional resources, lectures, multiple choice to help you, whether you are an accounting student taking an auditing course or studying for the CPA exam. Invest in yourself. Farhat Lectures is always here to help, and stay safe.